the coronavirus pandemic has quickly evolved from a health crisis into a financial crisis as well, shuttering businesses, upending entire industries, and sending financial markets reeling. In response, the Federal Reserve has taken unprecedented action. Earlier this week, the St. Louis Federal Reserve estimating that the number of people who could be laid off in the second quarter could top 47 million, and the unemployment rate could hit 32%. Joining me right now on the telephone is the president of the St. Louis Federal Reserve, James Bullard. Mr. President, it's always a pleasure to talk with you. Thanks very much for joining me this morning.
Great to be here, Maria.
So tell us what's behind this this cautious expectation here on unemployment. Can you walk us through how the bank gets to that steep worry of an unemployment rate skyrocketing and all of these layoffs to come?
Yeah, that 47 million is the number of people at risk. They're in jobs that are customer-facing or would otherwise be impacted by the virus situation. So the question would be, how many of those people are actually going to go and seek unemployment insurance, which I wouldn't call unemployment insurance here. I would call that pandemic relief. But we think anywhere between, could send the unemployment rate anywhere between 10% and actually the high end is very high, 42%. But that would require all of those people to go and collect pandemic relief, and I'm not sure that that's really going to happen. But the 32% is somewhere in the middle. But it just shows you that this is a special quarter. It's going to be a special quarter in macroeconomic history for the United States. We have a pandemic adjustment period. Instead of maximizing output is what we usually do, we're actually trying to minimize output. I think everyone knows the drill here. We're telling people to go home, take it easy. We're not going to be doing a lot of work. We're not going to be producing a lot of things during the second quarter. And the numbers are all going to look very funny compared to normal quarters where we're trying to produce as many goods and services as we can. And so everything's upside down in terms of interpreting the numbers. But I think there are plenty of resources. I think we can get through this. I like the bill that was passed. I like the actions that the Fed has taken. So I think this is all very doable, but it's a one-time situation, very unusual, and we have to work hard to get through it here.
So I want you to walk through the most extraordinary moves by the Federal Reserve, because combining the Fed and the Treasury's balance sheet in terms of leveraging up the amount of money to lend out is obviously incredibly powerful. What do you see as the most important policy change that the Fed has made in the face of this pandemic, James?
Well, we've done quite a few things. Obviously, we lowered the policy rate right away. That was just weeks ago, I guess 2 weeks ago or something. Seems like a long time. Then we set up programs to make sure markets are functioning appropriately. We had some, liquidity issues, I think, in the U.S. Treasury market, which it needs to be functioning appropriately in a situation like this. And then other markets started to freeze up a little bit. We brought out a lot of the programs from the 2007-2009 period, and I think we're able to restore liquidity and market functioning. What you really want, investors are very nervous, obviously, and obviously it's an unprecedented situation. So what you want is price discovery. You want normal pricing. You want people to be able to price assets, and I think we're getting closer to that. It's not perfect yet, but it's much closer than it was even a few days ago. So that's been very important. And then the teaming up with the so-called 13(3) authorities, which are unusual and exigent circumstances, and the Fed can do lending in conjunction with the Treasury. Those are very powerful tools. Those were in the legislation that got passed just a few days ago, and so I think that will help us a lot in dealing with this very special quarter, this really unprecedented quarter in U.S. macroeconomic history.
And you just mentioned the lending facilities. Yesterday, you also broadened that out to international. The Fed launching the temporary lending facility for the first time that would allow foreign central banks to convert their holdings of Treasury securities into dollars in a bid to alleviate strains in the global markets as well. You said that the second quarter is special. We're going through this special moment in time. Are you believing that this could just be the second quarter, or are we going to have a special third quarter as well?
Yeah, the analogy I like for this is that you're driving the car down the highway at 70 miles an hour. That was where we were in the fourth quarter and the first part of the first quarter. And now you come to a construction zone, and you have to slow way down. So there's nothing wrong with the car, but you've got to slow way down. It's a special situation. You know, you want to wind your way through the construction zone, then you'll be able to speed up again. So that's really where we want to be here. We want to keep the economy intact, all ready to go. Once the virus goes away, we'll move back into full production. But for now, we're telling everybody to not produce, to go home.
Yeah, I mean, these are emergency moves, James. And of course, on the 15th, the emergency move on that Sunday when the Fed dropped the benchmark interest rates all the way to zero, launched a new round of quantitative easing, $700 billion worth of asset purchasing with those mortgage-backed securities and treasuries. A lot of people are wondering, well, what other tools do you have in the box? I mean, what if this keeps going? We already have interest rates that are negative in some corners of the Treasury curve. What are you thinking in terms of the next tool that you may need, given the fact that you've sort of put all the bazookas out there at this point, right?
No, we have done a lot, but I think these 13.3 lending authorities are quite powerful. The Treasury Secretary has noted that you could leverage up to, I think he said $4 trillion based on this one program. So I think there's plenty of resources here. Just to size what's happening for your viewers, in a normal quarter, in very round numbers, the U.S. would produce about $5 trillion worth of goods and services. So we're gonna throttle down and only produce essential services plus whatever we can produce from our houses, work from home.
Okay.
And surely that is something like half of what we would normally produce. And it depends if it lasts the whole quarter or not. But just suppose it lasts the whole quarter. Well, that would be $2.5 trillion. So that's $2.5 trillion of income that households don't get during the second quarter. And a way to pay for that is partly just to consume less. We'll probably consume less because we can't go do a lot of the things that we normally do. But also, we're just going to have the government go out and borrow, and they're going to try to keep all these households whole and able to pay their bills in the second quarter. Yeah. And then we'll come into the third quarter. We'll transition to something better. It'll take a little while to to turn everything back on. And then by the time we get to the fourth quarter, I think that'll be a boom quarter for the U.S. economy. Everything will be back on, and we'll be in full throttle again.
So you think the fourth quarter will be a boom quarter? What's a boom quarter? You think GDP can rally like sort of in the 5 to 8% range, which is a lot of people have talked about those numbers?
Oh, Maria, we have to get, this is way out of normal numbers. Too early to tell. So if you look at China, some of the estimates on China are down 50% in the first quarter, plus 60% in the second quarter. So the kinds of things that we normally talk about, plus 1 or 2 or minus 1 or 2 or something, it's just off the scale. So it totally makes sense. You're trying to deliberately slow the economy down in the second quarter, and then it's going to speed up in the third quarter, and it's going to be going very fast in the fourth quarter. So I think that's still the right way to think about this. All viruses ever have been temporary.
All viruses have been temporary. Well, I like to hear that. On top of all of this, we got oil prices where they are. How tough is that making the situation, given the fact that we're expecting bankruptcies here? Real quick, James, we're running out of time. Sorry.
Yeah, oil is going to hurt Texas and hurt our production, so that's an extra factor though on this. And oil is a boom bust kind of cycle anyway, so it's tough for them though.
So in terms of the oil sector, I mean, this was one of our strongest areas. Do you think we'll see a lot of bankruptcies there, James? I mean, you know, looking at oil, where it is at $20 a barrel, 20.57, it broke 20 the other day. I know that sort of complicates an economy even further because this was one of the key places we were seeing job creation.
Yeah, it's a tough situation, and the Saudis and the Russians decided to have a price war just as global demand was collapsing. I'm not sure that was the wisest thing there, but the only thing I can say is it is a boom-bust business. We have seen periods when oil prices have gone extremely low, and then they've rallied later. So I think the players in that market understand that how volatile this world really is from their point of view. But we have great producers out there, and they'll find a way to live and fight another day.
Yeah, and before you go, James, real quick, you just said, well, we'll borrow more. We keep borrowing. You've got all these stimulus packages. The president's talking about a fourth package. When does the debt and deficits, when do the debt and deficits become a real issue, James? Because we're talking about we're adding to our debt every day with this. I recognize we're in a crisis situation, but you also want to see some spending constraint at some point, right?
No, I agree with that. But if ever there was a time when you wanted to do a lot here, I think this is the time. This is a very unusual circumstance, and you want to keep these households whole, able to pay their bills through this very special quarter. And the good side of it is that we're borrowing more, but we're borrowing at low interest rates, so that's very helpful in this environment. And we will have to address spending, but we can't worry about that right now.
All right. So you think we'll be back in balance? We'll see a boom quarter in the fourth quarter. And then in 2021, you're expecting growth, sir?
Oh, yeah. I think that's the plan. I think there's every chance that we can execute this. But a lot of this is about execution right now. Just in the days ahead here, setting up these programs, making sure people know how to get the relief that they need during this special quarter, making sure that households can go over and get the unemployment insurance, and businesses can get these important loans and possibly loans forgiven for this special quarter. Yep. So hopefully all that works. But boy, it's a big country, and being able to get all those funds out to the appropriate people right away is a tough task. So we're working hard on that with the Treasury right now.
James, thanks very much for joining us. I know you and your colleagues are working hard, and the country appreciates it. Thanks for your leadership. James Bullard.
All right, thanks so much,
He's the
Maria.
president of the, and we'll see you soon, president of the St. Louis Federal Reserve.